Intercontinental Exchange and OKX have launched perpetual futures contracts for Brent and WTI crude oil, offering 24/7 trading access. These contracts allow digital asset traders to gain exposure to oil markets without the constraints of traditional expiration dates. ICE provides regulated pricing benchmarks, while OKX manages crypto-based margin and platform distribution. The initial rollout targets markets outside the United States to align with current regulatory frameworks. This move represents a significant integration of traditional commodity markets with digital asset trading infrastructure. The contracts reference ICE's Brent crude and WTI crude benchmarks, enabling continuous trading access for crypto market participants. Unlike traditional futures, perpetual contracts allow traders to hold positions indefinitely, with funding mechanisms that maintain price alignment with the underlying assets. This collaboration merges ICE's established regulated futures pricing infrastructure with OKX's crypto margin trading capabilities and global distribution network. The oil perpetual products are available in jurisdictions where the exchange maintains regulatory authorization, ensuring compliance with existing rules. This framework separates U.S. regulated pricing from international crypto trading to satisfy compliance obligations. Analysts note that this agreement strengthens ICE's strategic relationship with OKX, as ICE holds an equity position in OKX and has board representation through their partnership. The move highlights the evolving relationship between crypto platforms and traditional financial markets. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Traders now have access to a new asset class without the need to navigate traditional futures expiration cycles. The perpetual nature of these contracts simplifies position management and allows for continuous exposure to oil price movements. This could attract crypto traders who are familiar with perpetual futures in digital assets but are now looking to diversify into commodities. The 24/7 availability of these contracts aligns with the round-the-clock nature of crypto markets, potentially increasing liquidity and participation. The use of regulated benchmarks like Brent and WTI ensures that the contracts remain anchored to real-world pricing, reducing the risk of speculative divergence. However, the initial jurisdictional limitations suggest that regulatory hurdles remain a key factor in expanding these products to broader markets. The integration of regulated pricing with crypto-based margin systems is a novel approach that could pave the way for more hybrid financial instruments. This development is part of a broader trend where crypto platforms seek to expand into traditional asset classes while maintaining compliance with regulatory standards. The success of these contracts will depend on their adoption by traders and their ability to attract sufficient liquidity. The next signal to watch is whether trading volumes on these contracts increase and whether other exchanges or platforms follow suit with similar offerings. In other commodities, the mechanism behind perpetual futures involves a funding rate that periodically transfers payments between long and short positions, helping to keep the contract price close to the underlying index. This is particularly important in markets like oil, where physical delivery and storage costs can influence pricing. For traders, this means they can maintain positions for extended periods without worrying about rolling over contracts or facing liquidity issues at expiration. The stakes are high, as this product could bridge the gap between the fast-paced, digital trading world and the more traditional physical commodity markets. If successful, it could lead to a broader acceptance. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Of crypto-based trading mechanisms in other asset classes. However, the initial focus on non-US markets also signals the complexities of navigating regulatory environments, especially in regions where crypto trading is still under scrutiny. The next key indicator will be how these contracts perform in terms of volume and volatility. High liquidity would suggest strong demand and a willingness among traders to use this new interface between crypto and commodities. Conversely, low participation could indicate lingering skepticism or regulatory uncertainty. Overall, this partnership marks a pivotal step in the convergence of digital and traditional finance, with the potential to reshape how commodities are traded in the future.